hear us?
Yes. You good? Okay. Or they're going to charge you a fee to do what you can do for free. So do not use any of those resources. Only work with your student loan servicers. They're there. The actual federal government is there to help you with your student loans. Do not use any sort of third-party service. That's my soapbox moment for that. But I've had clients who have gotten caught up with paying places to do what they could do themselves, and what wound up happening is basically they did nothing and they just kind of stole their money. It was a legitimate business, but obviously it was a scam. So two resources that I want to share that's important is the National Student Loan data system.
Sorry guys, just hoping, I don't know if anybody else can hear Vanessa right now, but I know I cannot. So just bear with us for a moment.
Can anybody else hear? Okay, I think it might just be her. So that is actually the brain. That's going to have all of the information that for your student loans. So every single loan and every action that's taken as far as repayment, if it's in a deferment, a forbearance, if it's transferred, if it's paid off, if it's consolidated, it will house all that information. That's particularly nice.
Right. So maybe it's just me, but it seems like most everybody can hear you, Vanessa.
Okay. Sorry. So that's going to have all that information. That's particularly helpful if you don't know where some of your student loans may be. If you have different servicers, that may be why, and that's where you can find that information. And then you have studentloans.gov. So you may be familiar with that site. That's where you have to do your entrance and exit counseling. That'll also be where you can apply for income-based repayment. And one reason is if you do it from there, if you have multiple servicers, it'll go out to all of those servicers instead of you going to each servicer and doing the same thing. It's really all one form. You can also look at repayments. If you aren't in a repayment right now and want to see what the estimate is, that's a great place to do it. You can log in and get your actual student loan balances and interest rates, or you could use an estimate. There's no cost or anything for that. It's a great resource. They also have other information about student loans, and they go over certain things like subsidized and unsubsidized and certain amenities you may have with certain types of loans that you have. There's some loans like a Teach Grant and other things that have some different implications with them. So that is also where you would find out that information. You know, how long does it take for my public service loan forgiveness to kick in, or my Teach Grant, or etc. I'm going to talk very briefly about the student loan repayments. They're standard, and then there's income-based. So your standard is a fixed amount, or graduated, or an extended plan. So what that means is that the standard fix is just the balances of the loan's interest rate in a term, divided out, that's your payment. Your extended is if you're over $30,000 in student loans, federal student loans combined, automatically switches over to a 25-year repayment. Obviously, because that would be hard to pay that off in 10 years. Not that it's easy within 25 years, but obviously a lot easier. So those are your two standards. They're not based on your income. Unless they're graduated, they won't change. That's just what it is. And then your income-based repayment has to be recertified every single year. Usually your loan servicer will contact you. However, you may want to make some sort of note about 2 to 3 months before that first year ends, so that way you know to renew soon. It's really important that you do that, because if not, and you stay at a $0 payment or $100 payment, and that expires and you didn't recertify, and now you're $800 or $900 a month or whatever it may be. It's really important that you do that. You can do that at studentloans.gov or through your servicer online. And there's also a plethora of information that goes over the different types of student loans there are. There really are a lot of different options, but you really want to make sure what you select when you start is something that's going to be good for the future. meaning you usually can't switch between plans every year. So if you're an income-based repayment today, you can't say, well, I want to go to pay as you earn, and then I want to go back to income-based. They don't allow that. It's once you're in one, you have a little bit of wiggle room, but not much. So you want to make sure you're picking something that makes sense. Not that if your income changes drastically, you can't do something else. However, if you're in one, particularly income-based, you cannot switch back and forth. So to go over some budgeting tips, these are just some mostly personal tips that I've had that I work with my clients with. If you don't have a written budget, you should. You don't have to nickel and dime every single penny. Budgeting is not a fun task, but it can be overwhelming, and it changes. Your income changes, your life changes, your expenses change, your budget has to change as well. Do what makes sense for you. And if you don't have something now, start off small, weekly or bi-weekly, monthly, and then you can start forecasting as you get more comfortable out. For me, I plan at a year at a time, which is probably a little crazy, but I do certain things for long-term planning. Like if I want to go on vacation, I need to know what I need to save every month to get that goal in next year and the year after. So that's kind of why I do that, and I update that as my income or expenses change as well. But that's just me. You don't have to be as retentive as I am, but that's what I do. So that's why I know a lot about budgeting. You start simple, change is inevitable, invest time in planning. It's not a budget that you say, okay, I'm following that, and you don't look at it again. You need to update it weekly or maybe bi-weekly when you get paid. Look at that budget, take out what's been paid or what you may need to go ahead and adjust. Expenses happen, life happens. Unfortunately, it doesn't always go by plan, but we can do our best to accommodate that. Create some short and long-term goals. I should say short and long-term goals because that term is what you feel is short and long-term. The short, the one person could be in a couple of months or in a year. Long-term, same thing. And based on what you have going on, I'll give you an example that's personal for me. This year for 2019, I wanted to pay off all of my unsecured debt by the end of the year. So that to me was a short-term goal was a year. A long-term goal was to pay off my car by the end of 2020 when I believe it's due to be paid off 2021. So that to me is a long-term goal, and that's a 2-year goal. Your short-term goal may be something very simple like saving up for a trip or for a certain expense or something along those lines, and maybe it's only a month or two. But you only have so much money coming in, and you probably have a lot of it going out like everybody else does. Have emergency reserve. Even if you have it at a separate bank, have something, have a nest egg. Ideally 3 months of salary or more. Start small. You're not going to have it all at once, and you should put in windfall money. Windfall money is like your tax refund, any overtime that you may have. If you get that third pay of the month, if you're paid bi-weekly, or the fifth pay of the month if you're paid weekly, lucky. Whichever works for you, but try to build that up so you have it. It really does help. You don't know exactly when you're going to have a bad day, but things happen. Start a conversation with your friends and family. Ask them how they budget. My mom uses pen and paper, which I can't do because I have to travel with it, right? But that's one of the ways I learned my habit. And then what I did was create an Excel sheet, and that's what I've been using for like 16. It's this Excel sheet that I just update and add different tabs to and sheets and such. That's just me personally. Maybe an app is best for you. Maybe it is just written. Change it up. Try it out. If you don't like it, then don't do it. I like Excel, but that's just me personally. I like Excel for almost about anything I can do in Excel, particularly with money. See what resources they have. Maybe they have tips, or maybe you might be able to share some information with them so that they can improve their financial situation and their financial plan. And then discretionary spending. That is an area, of course, of where we can do whatever we want with our money. However, we still have to have some sort of plan, particularly with food. Food is one of our largest expenses that most people do not track because, of course, you're paying out a little bit at a time, or you're going grocery shopping periodically, maybe twice a week, once every other week, or never if it's up to me. I hate the grocery store. However, you got to have a plan for it. To give you an example, most people think they spend about $300 a month on groceries for just themselves. That's only $10 a day. I guarantee you spend more than $10 a day on food. Some days you may not, but probably most of the time. So track that spending, see how much you're actually spending, and then go ahead and base it off of that, or maybe cut back depending if you're spending too much, maybe like a Starbucks drinker, myself, who's probably a little too much there. So some days I have to say, no, not today. You're a little over budget for that. And then lastly, in this webinar, that outline has some resources for some apps and some resources for online that you could use. So use smartdollar.com. That's hooked up with Dave Ramsey. That's a big name in the field. You also have Mint. You have Every Dollar, Good Budget. Some of these apps also work for couples. So if you have a significant other and you want to share in your expenses and your income and such, you'd be able to track that, and they can actually share in that and see. You can work on it and chat within the app. It's pretty neat. That's not something you have to do, but if you have a significant other, it's probably good to be on the same page with your finances. It's just helpful, and as we all know, the number one cause of divorce is finances. So definitely make a plan and stick with it. And that's my 15.
Awesome. Thanks so much, Vanessa. That was great, and so sorry about the challenges that I was having on my end, but everyone else could hear you, so that is fantastic. Just wanted to, since we have a few more minutes in this little time frame, since I started a few minutes early, any questions that anyone has at this moment for Vanessa, any of the tools she shared, or any of the tips and strategies she shared as well? Just open it up to the floor. Either anybody can chat in or unmute and share your question. Seems like there's a few people typing, so I'll just wait patiently. We have a question from Megan. The debt pay off tool. Any specific information you want to share about that, Vanessa, that maybe you didn't touch upon, or how it works?
So that is, the powerpay.org is, if you've ever heard of a debt snowball or a debt avalanche or something along those lines, that's what you can do with that powerpay.org. I highly recommend using the website versus the app. You can actually have an account, go in and update the information. It was really very interesting. I actually did a whole statistics paper on the debt snowball. At first I thought it was ridiculous. How could you pay off debt in the most efficient way by paying the smallest balances first instead of your highest or highest interest bearing account? But it's more of a psychology thing. But it was really a really good tool. It actually doesn't make a difference as long as you stick to the plan. And that's why I like that site. It is from a university, so it is not a for-profit. There's no cost or anything to it. There's probably other websites. That's the one that I recommend. It's this Dave Ramsey idea. It's just a free website to utilize. They do have an app as well, but you just won't log in and it doesn't save the information. That's the only caveat with that one.
Awesome. Great question, Megan. Awesome. So no other questions for Vanessa at this time. Just want to check in.
Go on, you always type it in, and then we can address it at the end.
Thanks, Suzanne, for your little comment about your specific short-term and long-term goals that you've been doing for your specific spending. Awesome. So if anybody thinks of any questions for Vanessa, we will definitely come back to all of the panelists at the end and touch base on any other questions. So thank you, Vanessa, for your piece. That was awesome. Now I'm going to switch it over to Mike Gillespie, and he is going to share some information about a family financial plan.
Hey, great job, Vanessa. Just to give you guys a little background about myself, what I do is I help professionals and business owners essentially make informed decisions about retirement planning, estate preservation, and just overall managing cash. So my kind of spiel now is creating a tailored financial plan. And just to throw some statistics out to you guys, and I found this on EBRI survey, CB Wealth Leadership Council, only 13% of American workers feel very confident about achieving their retirement goals. This is either buying a retirement home or putting their children through college. And only 39% of investors actually have a financial plan. So what I'll do is kind of go through my practice of how I go about creating this plan. And my first question to anyone who meets with me is, what is your hopes and dreams? I need you to dream as big as possible. And there's no such thing as too small or too large. So this is kind of like the goal of my discussion is about long-term planning and financial goals. So the first few questions I ask, and I want you guys to think about it as well, is how do you want to spend your time in retirement? Whether you sit down with a planner or you don't, or if you're doing your own budget analysis for yourself, ask yourself these questions. So how do you want to spend your time once you retire? Where do you want to live? What do those taxes in that particular state look like? What do you want for your family? Do you want to send your children to a prestigious Ivy League school, or maybe stay local to a local state school, or just save for a specific event, home purchase, or maybe you want to start a family? How much are the children going to cost you? So the point here is that every client that we work with, there's always different scenarios, and not every single plan matches every single person. You know, because one person might want to start a business, or might go out and just improve your overall golf game. So we have to incorporate, okay, how much you're going to spend on golf. So all taken into account, you can consider risk along the way of protecting your assets and protecting your savings in the event of a financial crisis, or just safeguard your money over a long period of time. So one question I get a lot too, and this is a question comes up a lot of time: how much money do you think you need when you retire? A lot of people, hey, I don't know what my net worth is. How much money do I need? So always use the 80% rule. So this is 80% of your current earnings is pre-retirement income. So for example, say you were making $100,000 a year. 80% of that is typically a retiree is going to be $80,000. So rule of thumb is to divide that number by 4%. So 80,000 divided by 4% is $2 million that you'll need to have saved in the bank. And there's a few processes that we use to kind of discover this. And the process begins, the relationship begins through a thorough understanding of your needs. And this is going back to your goals. Time horizon is very important. How old do you think you're going to be when you retire? Maybe you want to retire at 50. That's going to be very important when you develop the plan. Liquidity needs. Say you want to buy a home in 2 years. What's that going to cost you? How much money will you need to afford that home? And what a lot of important aspects that I kind of drive down on and hit the nail is tolerance to risk. A lot of people go balls to the walls with their money, expect 15+% returns every year. A lot of people find with 5% return. So that's very important with the financial planning process. And step 2 is we create this roadmap. Develop this investment strategy to help you achieve and protect the outcomes that you envision. Again, this is going back to buying a vacation home. Again, maybe saving for education for your children. And then step 3 is on you. Act. So we have to implement these investments. This is going to be retirement. You might need a trust in place. Cash management is huge. A lot of people even me personally, I have my money over at Bank of America. What is Bank of America paying me on my savings? 0%, 0.05. Now interest rates are very low. Banks are still offering, I believe, maybe about 2 to 3% on your savings. So a lot of people that come to us, they say, hey, what do I do with my cash? I don't care what you do with your cash. Just make sure you're earning some type of interest on it, because essentially you're just kind of like letting that money float out the window. And then step 4 is what we do is we adjust and monitor the plan. So I'll help you monitor progress and make adjustments as life evolves. Life will change. Markets will change. Markets go up and down, and new tax laws always change. So when those events occur, it kind of influences your priorities and your goals. So we'll have to tailor the plan to that. And if you don't mind taking a look, I actually attach it on the slide here. So if everyone wants to scroll down, it says, why is spending so important? And I just want to touch upon this is a quick retirement savings rate. So the chart says $500,000 with using different withdrawal rates. Going back to that 80% rule, your income will last you your lifetime if you only withdraw 4% of your income during retirement age. So you'll see here, $500,000 will last you 42 years in retirement at a 4% withdrawal rate. And that's only $500,000. If you had $2 million, you're going to have a lot of money left over, and you'll be able to pass that down. So these are the very important questions just to ask. Are you on track to achieve your goals? Will you have enough money? Are there any shortfalls? So these are questions that are very important and specific to you that you should constantly ask yourself and always evaluate. I mentioned earlier that the first step, I help analyze key components of your financial picture, such as your investments, liabilities, assets, and the income you earn. So based on this, we can determine whether you'll have enough resources to fulfill those goals, buying a home, putting your kids through school. So if not, and shortfalls are very likely, it happens a lot of the time. As Venessa was saying, you kind of want to stick to that strict budget, and we'll look to address ways proactively to help you stay the course. So, with anything that occurs, I'll recommend any adjustments you may need to consider to maximize your chance of success. So, for example, suppose that one of your goals is to send your child to an Ivy League school, and you'd like to travel extensively when you retire. To afford both, you might have to keep working a few years longer than you originally intend to, or in order to maybe adhere to the original retirement plan, you might have to change that around. The Ivy League school is a goal. Maybe depending on if things change, maybe that might not be in the picture, and you might have to send your kid to a less expensive school. The point that I'm trying to make here is that planning for your future often involves trade-offs, and it happens and occurs all the time. And I could certainly help you see exactly what kind of trade-offs you need to consider. Anything else I want to talk about? Yeah, I think that's pretty much it. The main goal of this was kind of just paying attention to those questions. And as those questions change and evolve over time, just kind of monitor your savings and adjust where necessary. Any questions for me?
Awesome. Does anybody have any questions for Mike about his portion, about planning and savings? Looks like somebody's typing, Mike. I'll let you know what the question is in a second. All right, Mike, the question is, does the average person tend to retire later in life over the age of 65?
Hey, that's a great question, Katie. Great question, but that really depends on what you have saved and what goals you want to go after or attain during retirement. A lot of people live simplistic lives, so they don't need that income, and their situation is different than a lot of other people's, where you might have a person that wants to go out and buy $1 million boat. Okay, what's that going to cost? So they might have to even work past 65 to go ahead and accomplish that. So it's really important to understand what's important to you first, and kind of using that 80% rule to go through and be able to retire, if that makes sense. I hope I answered your question.
Any other questions for Mike? Awesome. Oh, we have another question, Mike, from Suzanne.
Okay, so she asks, as I am in my older years, that addressing your retirement goals early is more important than in years past. So goals always change is a great question. Because a lot of people say, okay, I have a goal to do this, but I end up not doing it. So this is very important to you. What I recommend is, if you can, all the other listeners for the younger crowd, saving at least 10% of your income. So 10% of your income for 20 years, and that's just investing in, we'll just say, just the market, the S&P. That 10% of your income typically it averages over to $1 million in assets over 20 years. So starting early gives you a lot more flexibility in the long term. Now, Suzanne, as you're in your older years, all you just need to do is just kind of really deep down think about what's really important to you, and then kind of do that 80% rule to see, okay, listen, I'm only going to withdraw 4% of my income or 4% of my investment for my days to come. What's that going to allow me to do? I hope that answers your question.
Awesome. Well, thanks so much, Mike, for sharing your input around financial planning and how to think about some of these things in the earlier years moving forward as goals change as well. So now we're going to move on to Kloey, where she's going to kind of touch upon retirement. And if anybody, again, has questions, we will have some time definitely at the end to answer some of those other questions.
Hi, everybody. I hope you can hear me. I am going to be talking about retirement, and I thought it would be important to bring up 401ks and what are they. As young alumni, you're going to start going into real world jobs, and when you sit down with your new employer and you start going over that new employee paperwork, a lot of the times you're going to run into a 401k. And it can be really intimidating when you're filling out all of that paperwork and you don't even really know what it is, and your employer is encouraging you to participate. So a 401k allows you to set money aside from your paychecks and invest in the market. This is in hopes that you're going to have a nice chunk of change waiting for you by the time that you're retired. And you don't really have to do a whole lot. So typically what happens is you set aside a percentage of your paycheck every pay period, so that could weekly or bi-weekly, sometimes monthly, depending on what kind of pay period your job offers. And by setting a percentage aside, it's basically a savings account in the market. So why should you sign up? I'm very passionate about 401k, and I started at a young age, so I'm very thankful for that. Because they allow you to invest in the market, the value of whatever you're investing now hopefully will go up by the time you retire, like I mentioned earlier. So when you sign up, typically you'll see a Roth 401k or a non-Roth 401k. And that is typically where I see a lot of questions come up, and it's like, well, which one do I choose? I don't understand. And the information can be really overwhelming. So I tried to simplify it the best I could. Pre-tax 401ks or just normal 401ks, if you see that, it won't say anything except 401k. That's typically pre-tax. This amount is taken from your paycheck before taxes. So what this means for your future is when you retire, you'll pay taxes on that entire amount of money when you retire. A Roth 401k, this is the amount that's taken from your paycheck post-tax. So what this means for your future with that is it allows you to pay taxes now while you're in a lower tax bracket. I'm just assuming here. And that helps you avoid paying higher taxes by the time you retire. If you believe that you would be in a higher tax bracket when you retire, this is probably a beneficial option for you. If you make more money now than when you plan on retiring, then it would most likely be more beneficial for you to choose the pre-tax option. It's really just kind of personal preference, but I do run into those questions where people just don't understand, and it kind of turns out to be a lot more complicated than it really needs to be. I guess my next point is, what should you look for in a company with a retirement plan? I know for me, luckily I've landed a job with a really great company, and I hope to stay there long term. But when I was interviewing, it was really important for me to understand what kind of benefits my future employer is going to be offering me. And 401k was something that I was really passionate about and really excited to learn more about as far as the company. So in my opinion, I think asking the company if they have any kind of match is very, very important. Match is basically free money. So if you put in 6% of your paycheck, every week, bi-weekly, monthly, whatever it is, your company will match that. I'm not saying it will match 6%, but a lot of companies will match a certain amount, which is free money. So if you put in 6%, your company will put in 6%, so you're really getting 12% in your 401k every pay period, which is great. So I think when you're trying to figure out, well, I don't know how much to put in, I would definitely see what you can afford first and foremost. But secondly, if you can afford to put in that full amount that your company is going to match you, it's really going to help you in the long run. When you're looking at investments, it can also be overwhelming. Typically, you'll have a sheet of paper in your new employee paperwork, and it'll have a ton of investments on it, and you're supposed to pick one. And you're probably just sitting there like, I don't know which one to pick. You certainly could consult your financial advisor. That would be the recommended option. But just to kind of get an idea on, what these investments mean and what they are, typically they are, a variety of different funds. So they can be stock-based, mutual funds, bonds, which are also known as fixed income securities. They can be cash-based or money market funds. My favorite, just when you're starting out, to make it easy, there are funds called target date or life cycle funds. These are basically intended to be one-stop shop investments. So they blend all of those different securities together in an age-appropriate manner. So you'll see like a target date fund of 2065. And the idea of those is to pick a fund that has the end date of the year that you would be closest to retirement age of 65. And as the years go by, the funds start out pretty aggressive because when you're younger or when you're just starting out, you can afford to be a little more aggressive when the market changes. And then as you get closer to that, say, 2065 age or date range, I should say, the investments will go a lot more conservative. So these are things that I see people choose quite a bit just so they don't really have to think about it too hard. So it's really personal preference, on what you want to do or what you're interested in doing. But if you really don't know, I would definitely say just consult a financial advisor and see what fits best. Another question I see is what happens when you leave your job that you are contributing in your 401k? And there's a variety of different things that you can do. You can certainly just leave the money alone. Plan. It can stay invested there and it can continue to grow, but no new contributions can obviously be made. One thing to look at with that, though, is a lot of employers in their plan document will have a minimum amount. So I know for me personally, if you don't have $5,000 in there by the time you leave your company, then you will be forced to take that money out. So you can take that money out by taking a lump sum withdrawal, which I definitely don't recommend because then you will receive some penalties, or you can roll it over to your new plan, which that does not have any penalties when you're with your new employer. If you want to just kind of keep all of your money in one place. 401ks also allow you to take loans. Well, I guess not all of them, it's really employer-based, but loans are not recommended, obviously, because it's just hurting you in the long run. But if you do find yourself in a financial pinch, you can certainly borrow from those. There are things called hardship withdrawals. So there's a variety of things that you can use those for, student loans, medical bills, buying a house, things like that. Again, not necessarily a great choice because you're just taking away money from your retirement, but it does help you if you need it right away. So that's kind of what I have on 401ks. If you scroll down, I believe it is the third page, there's a graph and it's called growth of savings. So it shows three different people, Susan, Bill, and Chris. They all invest $5,000 annually, but they're all in different age ranges. So if you see Susan, she's between the age of 25 and 35. So she invests a total of $50,000. And then Bill is between the ages of 35 and 65, where he invests $150,000. And Chris is in between 25 and 65, and the total he invests is $20,000 or $200,000, excuse me. So Chris, he has started very early, and you can see how much his savings has grown. Bill, with him being on the older end of things and just starting a little later, you can see kind of how much money he's lost there than if he would have started when he was between, the ages of 25 and 35. He could have made up about a little under $500,000 there. So that's quite a lot of money, and it just shows, I thought it was a nice visual to show how important it is to start contributing to your 401k if you have the opportunity to sooner rather than later. So if anybody has any questions on 401k, let me know. Otherwise, we could talk about some money management as well. So I'll just kind of pause there for a second.
That was great. Thanks so much, Kloey. Any questions on 401ks for Kloey right now before she jumps into the next part? All right, Kloey, go right ahead.
All right. So I thought with everybody being young alumni, something important to talk about was student loan consolidation. This allows you to consolidate multiple loans into one loan, and it gives you one single monthly payment. For me personally, I did have to take out some student loans, and when I graduated, it was really overwhelming because I felt like 100 different loans, and my payment was getting split up between each loan, and I was thinking to myself, there has to be an easier way to manage this and an easier way to get this paid off because I don't really understand what's going on. So I talked to a professional, and when I consolidated my loans, it lowered my monthly payment because it did give me a longer time to repay my loan. This is a pro and a con. Just starting out after graduating, it was a pro because my monthly payment was a lot lower, and that made me feel a lot more comfortable just financially and budgeting because I felt like I could guarantee that I can make that small amount. However, if I have any extra money, I certainly can start throwing it at the student loans and start getting it paid off sooner. Consolidating your student loans also gives you access to income-driven repayment options, and you can switch from variable rate loans into a fixed interest rate. So I think those are very important things to consider. Student loan consolidation is not for everybody, but it is for some people, and it's a really great option that a lot of people don't take advantage of. So I thought that was important to bring up. My favorite option with money management is setting money aside from each paycheck. So this is separate from your 401k, obviously. But if you're struggling to save money and trying to figure out where do I even start, what I started doing in the beginning when I started working is I would pull a certain amount of money out of my paycheck each period as cash, and I would set it aside. And then I was like, well, there has to be an easier way to do this as well. So I decided to open a savings account, and I would throw that money in there. So for example, if you have 26 pay periods in a year, which is a bi-weekly pay schedule, and you just take simply $100 out of each paycheck, that leaves you with $2,600 at the end of the year. So if you did this for 5 years, you would have $1,300 in that savings account, which $100 can be a lot for some people, but also it can be an amount that, you don't really notice it's gone if that's something that you consistently start doing. You can obviously start small and watch it grow. And then, like I mentioned, with the savings account, if you're one of those people who starts putting money in your savings account and then you kind of run into a financial pinch and then you start grabbing money from that savings account, that's not going to help you in the long run. So I think opening a separate bank account with either the same bank that you're currently with that is not connected with the bank that you use every day, or going to a different bank and opening a new account is a good tip for saving money and managing money. That way you're not really tempted to touch any money that you're saving and dip into that. So I think it makes it easier to forget the money's even there, and it will help you in the long run. So I'm a little short, I guess, on my 15
You're good, don't worry.
If anybody has any questions, that's about
That was awesome. Thank you so much for sharing, Chloe. Let's see if anybody has any specific questions. Emma, it seems like you're typing, and you could also just talk if that's easier instead of typing. I don't know if you have a question. Oh, there it is. Perfect. All right, Chloe, go right ahead of that.
Okay, so there can be more requirements than just amount of money in the account. For example, I left my employer before 3 years was up and they took back all of the matched money. Emma, great question. It's really dependent on your employer. What I do, just because I'm knowledgeable about 401k, when I get hired, I ask for a copy of the plan document and I read it through myself. That happened to me in my first job, and I was really shocked because I was like, oh my gosh, they took like $12,000. I was like, how can they do this? But somewhere in the plan document, typically there will be a clause where it will say, it's called vesting. So some employers, you are 100% vested in what you contribute. Well, you're always 100% vested in what you contribute, but sometimes employers will give you 100% vesting in that match. But a lot of employers usually have a 5-year schedule. So for my employer personally, it's 20, 40, 60, 80, and then at 5 years, I'm 100% vested in the match. So I hope that kind of answers your question. It's really just dependent on your employer and how it's written in their plan document. But you are correct. Sometimes if you do leave early, you will lose some of that matched money.
Any other questions for Kloey about anything she just shared with you all? Kloey, I don't know if you just saw, yeah, Emma.
Correct.
Okay.
Yep, so that's just like the company I work for. Like I mentioned, my first year, I'm 20% vested. So if I left after the first year, which I've already surpassed that, but if I did, I would get to keep 20% of that match, and they would take the 80% back. The company.
Awesome. Any questions? Thanks so much, Kloey, for answering Emma's question. Any other questions in general from any of the panelists? Anything that we talked about tonight that you still have questions about? The floor is open, so you can either audio in or chat in a question that you have or something you're still curious about, or something that would be a tangible next step for any one of the things that were discussed tonight. That's a great question, Katie. I feel like you all could answer that. So whoever wants to start, go right ahead.
Working with a financial advisor is not right for everyone. It's really how complex your financial situation or the scenarios that you're working with are involved. A lot of families, they have, say, for example, a lot of real estate. They own a lot of real estate. And just in case something happened to them, they wouldn't want to lose that. So then you would have to work with an advisor to reach out to a certain trust attorney to make sure all those assets are kind of commingled together, and it's basically passed down to legacy to legacy. So it really depends on your financial situation, where it's right for you to work with someone or it's not. And it's also based on the level of your comfortability working with investments yourself. If anyone wants to add anything else.
I think something to note too is my previous job, they actually offered, if you contributed in the 401k plan, they actually had personal financial advisors that you could call or go meet with for free. So I would definitely check with your employer too to see if that's a benefit that they have. And then that way you're not, I guess, investing in a personal financial advisor. But yeah, just something to note.
Awesome. Any other questions that anybody else has? So you kind of wrap this up. Cool. Well, I will just again say thank you for everyone for participating, engaging in this webinar. Like I mentioned, this is the first of hopefully a few different series that we will be doing around future planning, adulting in general, as well as career-based events as well. So before I send everybody off, if any of the panelists want to just give like one more nugget of information, last thing to think about before we send these young alums off into the world to make some financial decisions. Venessa, if you want to start, that'd be awesome.
I don't know if I said it before, I probably did, but it's really important. If you fail to plan, you plan to fail. You really should have a plan for your finances, and particularly a budget.
Awesome. Mike?
Yeah, going back to kind of what I said too as well, like general rule of thumb, if you can, save at least 10% of your gross income. And time horizon is very important. We use the, basically take your current age, if you're 20 years old, subtract that from 100, and then you get 80. So 80% of any of your investments should go into equity, and then decrease that while you get older.
Awesome. Kloey, you want to round us out with anything? All right. Well, thank you again for everyone for being a part of this webinar. I hope that you learned something today. You're curious about something. You're going to go and move forward on one of the topics that were discussed. I'm really excited to hear from you all. If you have any feedback or suggestions about things that you want to hear about in future webinars, events that we can do regionally, you know, we are trying to build this out. I am always willing to chat with any of you. If you have an expertise that you want to share, like our panelists today, we'd be more than happy to have you as part of an event in the future. So thank you again, and I hope you guys enjoy the financial planning webinar. Thanks so much.